This is Daniela Camboni for Kitco News, and we are at the Toronto Cambridge House Show. And my next guest has really made a name for himself, finding low-risk speculations in high-risk areas. He's Adrian Day of Adrian Day Asset Management. Adrian, thank you for being with me.
Well, thank you, Daniela.
So we saw each other recently at the Denver Gold Forum.
Right.
That was before Bernanke had announced QE3. It's now been announced, now in full swing. My question to you is, now what?
Well, you know, it's funny you ask that question because this is a problem with stimulus from a political point of view, from an economic point of view. Stimulus is a bit like being a drug addict. You know? I mean, you want more of it just to keep going. And each successive shot of stimulus has less effect on the economy. So you need more and bigger and more and bigger. But I think the Fed has set itself a very dangerous course here because this new stimulus is actually open-ended, whereas in the past they've always had a time limit to them.
Right. So, Adrian, do you think that the price was already, the QE3 factor was already baked into gold before it was announced?
Well, I think to some extent it was. Gold had rallied significantly ahead of it, but let's face it, gold moved very sharply afterwards, so it clearly wasn't all in there. And you've got just not the Fed, of course, but you've got the Bank of Japan, Bank of England, the ECB. ECB hasn't actually done anything yet. I think it's important to note. They've said they'll do whatever is necessary, but they haven't actually done anything yet. Right. But you've also had China, of course. So every major central bank in the world has stimulated over the last month. Right. And I think we're only going to get more of that, frankly. Right.
Now, Spain also announcing strong austerity measures. Yeah. How might that impact the gold market?
Well, that's a negative for gold because, you know, other things being equal, a recessionary period is bad for gold for a lot of obvious and perhaps not so obvious reasons. The obvious reason is that people have less money to spend, whether it's on jewelry or on savings. They just have less money. So recessions tend to be bad, and the austerity measures in Spain, if we get sort of more of that, that's a negative because that's the European economy is just going to slow more. What's a positive, of course, is how the central banks respond to that austerity, how the central banks respond. And what we've seen over the last couple of years, and particularly over the last month, is that central banks will respond in a way they've always responded, in perhaps the only way they know how to respond, which is just to throw more money at it. So perhaps in a perverse way, the austerity measures in Spain only will accelerate the European Central Bank actually doing some genuine stimulus instead of just talking about it.
So speaking about recession and people talking about things, let's look at the U.S. a second.
Yeah.
Is the U.S. dangling with the R word again, or people just like to talk about recession and U.S. at the same time?
I think it's more stagnation, frankly, than recession. I don't see the U.S. slipping into recession, a formal recession, but I don't see any kind of meaningful growth out of the U.S. I mean, they just revised downwards, for the third time, the GDP numbers. You know, it's very, very, very slow growth in the U.S. The U.S. is also, different regions of the country are doing better than others, and some therefore are doing worse than others. I mean, some areas of the country are in recession, particularly unemployment. I mean, with unemployment over 8% and so many people out of the job pool, it's really a very serious situation because the new jobs that are being created are not enough. The numbers are not enough to take account of new people coming into the job pool.
Right. So the growth is strong enough to prevent a recession, but obviously not strong enough to prevent people from talking about it.
Correct. Correct.
Let's move on over to China now, Adrian. China announcing stimulus measures, looking to move the economy. That seemed to boost gold recently. What are your thoughts on China right now?
Well, a couple of things. China is actually in a very difficult position, perhaps even more difficult from the point of view of stimulus than other countries, because China has a huge oversupply of residential housing, as we know. They are trying to dampen speculation in housing. So on the one hand, they have been at different times over the past year trying to tighten, to dampen that speculation. But on the other hand, with the slowdown in the European and North American economies, their export industries and therefore their manufacturing has slowed significantly. So they want stimulus for that. But of course, stimulating domestic industries doesn't have any impact on exports. If the US and Europe are still weak, that's not going to improve exports. So we're in a little bit of a dilemma there, because as we know, the slowdown in manufacturing now has been quite significant. You know, the layoffs in some of the factories that cater to export markets have been very significant, causing riots and, disputes and so on. So China's in a bit of a dilemma, as indeed are all countries. But from the point of view of gold, which was your question, I mean, this is again overwhelmingly bullish. Again, central banks around the world, the major central banks, in my view, are going to continue to stimulate economies or attempt to stimulate economies for the foreseeable future. It's basically the only thing they know how to do.
Well, that's an interesting point, Adrian, because I've spoken to some analysts who have said, yes, China's growth is at 6 to 7%.
Right.
7 years ago was about 12%, but the economy is much larger now. So in terms of demand for commodities, that should virtually be the same, no?
Absolutely, no question. And I would point out that with China, with China's growth rate at 7% and inflation under 4%, that is remarkably strong real growth, and compared with a few years ago when they had 10 to 12% growth, but they had inflation at 6 and 6.5%. Inflation was much higher a couple of years ago, so the real growth was, 5, 6%. Now the real growth is 3, 4%. A slowdown, but not the devastating catastrophe a lot of people seem to be talking about. Much larger economy, more people moving into the middle class, and I think, frankly, if you look historically, I don't know a case of a major economy that has started down the road of industrialization and just come to a halt. I mean, these things run a normal process, and now that they're on that, well on their way of industrialization and urbanization, is going to continue, I think. And that means the demand for resources is going to continue to go up. And whether growth is at 12% or 6%, it's still very, very strong increase in demand for resources.
Right. Just nickel and aluminum may be still suffering because there's just oversupply there.
Well, the problem is, you look at, say, copper, which I think the demand is almost a given. What's less sure is the supply side. Iron ore is in plentiful supply, nickel is in plentiful supply, aluminum is in plentiful supply, but other metals like copper are not. And so, you have to differentiate, but the demand is a given, I think.
All right, Adrian, now let's look at your area of expertise. I mentioned at the start, you look at low-risk speculation and high-risk areas. Explain this a little bit.
Well, mining, as we know, whether you're actually mining or whether you're exploring, is extremely high risk. It's a high risk business. In mining, they say Murphy works overtime. Anything that can go wrong, and a lot of things that shouldn't go wrong, do go wrong. Exploration, we know, I think is 1 in 6,000 gold anomalies ever becomes a mine. I mean, the odds of finding something that's economic are very, very long. And so I try to minimize that risk by being exposed to the area, but minimize that risk by looking at business models that mitigate the risk. So in the mining companies, I prefer royalty companies, like Franco-Nevada, Royal Gold, etc. Royalty companies that have upside, but they minimize the risk by not having to be responsible for ongoing capex and fixing problems. And in the junior sector, I look particularly at prospect generator. Prospect generators, as you know, they generate prospects and they joint venture those prospects out to senior companies who put the money up. So they're spending other people's money. Again, they're mitigating a risk because they're not putting their own balance sheet at risk.
But Adrian, when we look at the junior market, I've spoken to many analysts who have said 95% of the juniors won't really amount to anything. So how do you choose the winning 5%?
Well, that's the whole point. 95% won't amount to anything, some because of bad management, some because they run out of cash, but a lot of them, frankly, even with the best will in the world, they just don't find anything. I mean, it's just remarkably long odds. So if you find a prospect generator that generates prospects, farms them out to different people to spend the money, they might be able to farm out 10 or 20 different projects. So they have 20 chances, if you like, 20 lottery tickets. So they're increasing their odds of success. But more importantly to me, at the same time, they're preserving their own balance sheet. They're not spending their own money. Other people are spending the money. And that means that they're not going to blow up. They don't go away.
But Adrian, how is an average investor supposed to do their homework if you just have access to, the CEO's salary, the stock price? How can you get more informed, better informed?
I think that it's critical for people to do. If they're going to be in the junior sector, they have to really get involved. They have to listen to the interviews that you do. on the macro, they have to subscribe to a letter, may I say, like Brent Cook's. May I say that?
Absolutely.
You know, subscribe to a letter like Brent Cook's.
Right.
Get to follow someone who truly knows what he is doing, he or she.
I'm sure Brent will appreciate that plug. Adrian, thank you so much for your thoughts today.
Thank you.
And thanks for watching our coverage from the Toronto Cambridge House show. We'll have more videos for you on Kitco.com. In the meantime, you can email me any feedback at newsfeedback@kitco.com. Reporting from Toronto, I'm Daniela Cambone. Thank you so much. Yeah, it was really good.